This is Satoshi Guapamoto over at Bitcoin Community College, and today we're going to be going over some of the cost and benefits of holding Bitcoin miners, MicroStrategy, Bitcoin ETFs, and Bitcoin itself. All right. If you enjoy this type of content, please like, comment, and subscribe. Share it with someone who might find it helpful. All right. The channel's been blowing up. Let's keep it going. Also, for anyone who knows how to get dark mode on this, please let me know, bruh, because I've been trying to do it. I can't seem to figure it out. I'm on GitHub. I don't know what's going on. I am a victim of the American educational system, aka, you know what I'm saying? You can read it. Anyways, so first off, let's go over the Bitcoin miners. So this is what a mining facility typically looks like. A lot of crazy stuff going on. This is what the outside will sometimes look like. And again, this is what the inside will look like. And that's a small scale operation. This is clearly a large scale operation. So let's go over the pros and cons. Pros, miners are leveraged Bitcoin plays, meaning that the beta on Bitcoin miners is higher than it is on Bitcoin itself. You are essentially playing with a little bit of leverage. Sometimes it's 2x, sometimes it can be 3x, and we'll go over some examples. Um, to hold the miners like miner stocks such as Marathon, such as TerraWolf, such as CleanSpark, there's no fee to hold them. They're just equity. They are not an exchange traded fund. They are not an index. They're just a single company, right? One of the benefits as well, long dated options benefit greatly from the increased implied volatility over time. So because these miners are a hedge play on Bitcoin, which is already highly volatile, right? Typically, what we see is long dated options end up going completely crazy because of the implied volatility, which adds to the premium on the options, right? Large miners can acquire smaller miners, making their operational power increase significantly. So, when a large miner has an acquisition of maybe a smaller company that's going under, that can be a big boost to their stock. There could even be miners that are acquired by other companies that want to get into the mining space. That could be a boost for the stock of that miner as well. And finally, miners can use their facilities as cloud data centers when mining is not profitable. See Core Scientific. So essentially, Core Scientific, what they can do is they can leverage some of their computing power, some of their hashing power, in order to create cloud compute for AI data centers. So let's say the price of Bitcoin drops a lot and it's not profitable to be a miner. What they do instead is they switch over to their AI side of their business, right? They're working with NVIDIA and other companies in order to provide cloud data centers for AI infrastructure, right? So they basically have two jobs. If the other job isn't profitable, they switch back to the other job, right? Here are some of the cons, right? Miners must keep up with the cost of new, expensive, and powerful hardware. That's ASICs, right? An ASIC is a application specific integrated circuit. It's basically a chip that does one thing and one thing only, right? It's not good for anything else. So these chips only look for hashes. They just try to mine Bitcoin. They can't do anything else, right? So when Bitcoin's price is lower than miners need it to be, then their mining is not very profitable. So what they have to do is they have to turn off older machines or get rid of older machines and then buy newer, more expensive ones, right? That game is always going and going and going. Um, you must always find the cheapest renewable energy source in order to stay competitive. Now, this is a pro in terms of the environment and sustainable energy, but it's a con if you're trying to invest in a company that is looking to generate revenue, to generate profits, right? Because if you are mining using expensive energy, right, like drilling for oil and then combusting that oil and using that to power some of your generators that are making the electricity, you're going to lose to someone who has a hydro facility or a nuclear facility, right? Or like they're using a volcano, right? That's actually a real thing. In El Salvador, they're literally using thermo energy, right? Geothermal energy in order to mine Bitcoins because the volcano's just there. You know, that's stranded energy. You're going somewhere, you're building the facility on top of where the stranded energy is, and then you're capturing that stranded energy for as cheap as possible in order to produce Bitcoins. All right. Again, think about it this way. If someone has to spend $90,000 drilling the oil out of the ground and then creating the facility in order to turn that oil into electricity to mine the Bitcoin, they're not going to make as much money as the person who's able to use a solar farm that was $30,000 up front in order to make, and then mine the Bitcoin. And again, the price is 90,000. They're making a $60,000 profit, where the oil guy is making no profit at all because it takes $90,000 from him to mine a coin because he's using expensive material. He's using an expensive energy source, right? So they constantly have to be looking for cheap renewable energy in order to stay competitive. They must constantly expand their operations to stay competitive. Again, that meat goes along with buying machines, building out infrastructure, buying land in order to build the infrastructure on, finding stranded energy. They must have ample cash on hand in order to survive bear markets or times of high energy prices and stagnant Bitcoin prices. So again, maybe your cost of electricity goes up from 1 cent per terawatt up to 10 cents per terawatt, whatever it is. And when that happens, right, you have to find a way to remain profitable if the Bitcoin price stays the same. All right, so these guys need to have cash on hand. They cannot be over leveraged, and typically these guys are. They have a lot of debt, and sometimes they're not able to pay it off. They're not able to maintain their operations, and they go out of business. Mining is very cutthroat. Okay. Also, there's counterparty risk. You have to trust the CEO. You have to trust the board of directors. You have to trust the CIO, the CFOs. You have to trust all these guys. So there is counterparty risk involved. And you must be careful that they do not dilute you too much, which could scare away some investors. Again, hedge funds might not want to invest. Institutions might not be willing to invest. Retail investors might leave. Either way, there's a lot of things stacked against Bitcoin miners, and only a few will continue to survive. Bitcoin miners go out of business every single cycle, so it's very tough, cutthroat business. But again, the risk to reward can sometimes be high. Marathon Digital went from 70 cents, okay, all the way up to $75. That's insane, and it's currently sitting around 27. All right, CleanSpark went from about $1, all right, all the way up to about $38. And now it's currently at $14. And we look at TerraWolf. TerraWolf went from around $3.70 all the way up to about $40. And then it's currently sitting around $8 right now. So again, none of this is investment advice. This is just me going over some of the data and some of the pros and cons of what miners, typically what people are looking at when they're buying Bitcoin miners. What about the ETFs, right? Uh, I spelled it wrong. Exchange traded funds. Okay. First off, the pros. They're simple and they're highly accessible for most people. All right. It's not too difficult to open up your brokerage account, buy the ETF. If you're an older person, maybe you've been banking with Charles Schwab for a long time or whatever it might be. It's very easy to get into the ETFs. Another pro, they track the price of Bitcoin 1 to 1. All right, so there's no leverage here. There are no beta or gamma plays or anything. It's just straight up buying Bitcoin through a different instrument if you cannot, for whatever reason, buy Bitcoin yourself. This is mostly good for institutions who cannot hold Bitcoin. Um, More likely to be available in tax advantage accounts, right? Like you can't just like buy Bitcoin inside your 401k or your Roth typically, but it's a lot easier and more accessible to put that inside of your 401k or your Roth or whatever you might have if it's an ETF, right? Because that's way more regulated, it's way more standard. It's better for older people who can't self custody. Maybe they just can't figure it out. They're not really good with tech. It's probably not a good idea for them to try to self custody. They're probably just going to lose their Bitcoin and then be extremely poor, right? Because they lost their life savings, right? Because I mean, if you don't know how to like send an email, then yeah, you probably shouldn't be trying to do self custody. You should probably just be buying the ETF if we're being honest. All right. The cons is not your keys, not your coins. Basically, it's a paper IOU. BlackRock or whoever is issuing your ETF is telling you, hey, I've got the Bitcoin, but there is no in-kind redemption, meaning that if you try to redeem your IBIT shares for Bitcoin, that's not possible. You can only receive dollars for them, and that could be a bit of a problem for some people. Clearly, this is just a version of an IOU rather than actual Bitcoin itself on the blockchain. Another thing, you have to pay fees for holding an ETF, right? So some of the fees vary from, a quarter of a percent all the way above over 1%, right? So that's all dependent on whether or not, what type of ETF you're holding. Maybe you're holding the BlackRock one, maybe you're holding the Fidelity one, but either way, you're going to pay a fee for holding an ETF. And then finally, it defeats the purpose of the invention of Bitcoin. All right. Self custody of digital scarcity is the invention. So if you're not doing that, then you're kind of beating the purpose of holding Bitcoin. Again, ETF is like an institutional grade type of financial product. I don't know if most individuals really have a need for ETFs. They can just buy Bitcoin spot. The way it was meant to be bought. So if you can self custody Bitcoin, then please do it. It's actually pretty easy. One way to get started. All right. Try using Swan. All right. Buy Bitcoin with Swan or with Strike or even with Coinbase, if I'm being honest. You know what I mean? Like, I'm not a big Coinbase supporter, but the whole point is that you purchase your Bitcoin here, and then you move it to your wallet. You move it to your self custody. You don't leave it on Strike. All right. Because again, if they have your Bitcoin, then that means you don't. Do you understand? So here's an example of a Bitcoin wallet. This one is the BitKey. I don't personally have this one, but I've seen some videos. They're pretty cool. They're pretty good, and it's $100 for this one. I guess they're having a sale, and I really like the design. It's really cool. So reputable brand, Bitcoin only, and they have a full breakdown of how to use their product on their website. Blockstream Jade, that's the one that I use. Pretty solid, pretty good. I would definitely highly recommend it. Again, probably the cheapest one that you could buy, for being honest. So it's air gapped, right? So it's never on the internet. Your stuff is very secure on a Blockstream Jade. And again, go on bitcoin.org. Plenty of resources here, and one of them is this list of all these different and curated Bitcoin wallets that you could potentially use. And then we get to MicroStrategy, MSTR. This one's for the big dogs. All right. The pros, definitely the best rate of return against all other avenues, right? This thing is going up way more than Bitcoin, way more than the miners, way more than the ETFs, of course, right? Because this is a highly levered play on Bitcoin. The shares are accretive. You have accretive Bitcoin yield. So if you bought one Bitcoin worth of MicroStrategy a year ago, you will have more Bitcoin today than you had in your initial investment. You might have 3 Bitcoins now. You might have 3.5 Bitcoins now. All right, Bitcoin per share is always increasing. All right, and if you want to learn more about that, again, you have to check out Bitcoin University. He made a pretty good forced 4-part breakdown of this. And check out Quant Bros. These are the guys who really broke this stuff down for me at a high level. These kid analysts have more. They have literally better technical analysis. They have better macro understanding than most people who get paid millions of dollars to do their jobs. These guys literally pioneered this whole thing. It's truly amazing. So that's just one of the reasons why MicroStrategy has some pros over some other Bitcoin adjacent instruments. All right. Another thing, no fees to hold it. Right. There's no fees to hold this. This is just a security. It's available in some retirement accounts. I know that some people, even in the UK, are able to access MSTR in their retirement accounts. So that's pretty cool. Again, there are no real competitors in the space. Like MicroStrategy has no competitors. Like they have no real competition. Mining is a highly competitive business. MicroStrategy has no competitors, right? Because they're just a Bitcoin holding company. They're a Bitcoin treasury company, right? There's extremely low risk of liquidation, right? First off, the Bitcoin itself is unencumbered, meaning that like there is no liquidation risk on the Bitcoin. The only risk is the repayment of the debt that they have outstanding, right? MicroStrategy currently has a market cap of around 100 billion, and the debt that they have on their books is about 7 billion, right? So Bitcoin would have to fall to like 20K, and it'd have to fall really fast in order for MicroStrategy to be in trouble when it comes to the repayment of the debt and potentially them getting liquidated and their stock going to zero. Um, Long dated options, right? Again, extremely high yield because of the high implied volatility over time. A lot of swings up and down. Seller is literally leveraging volatility and selling volatility to the fixed income market and all this other stuff in order to gain a return on a stock. Upcoming catalysts that could be positive. Another pro, the QQQ inclusion, S&P 500 inclusion, and fair value accounting rule change. All positive catalysts that are upcoming for MicroStrategy in 2025. So that could be interesting for the price action. As for cons, again, buyers may dry up and may not be willing to issue debt or give Sailor debt or give Sailor money. So this is a highly unlikely, you know, scenario, considering that the people who are buying the convertible bonds, they're taking on a pretty asymmetrical risk, but it's still a risk nonetheless, right? This could happen. Bitcoin's price could tank really hard, like down to 20K. I guess that could happen. And Sailor could get arrested for securities fraud or something crazy, right? There's a single point of failure in Sailor existing. Don't get me wrong, there's an entire company. Sailor's not even the CEO, right? He's just like the acting chairman. But as the figurehead of the company, if he were to get locked up or something were to come up, some sort of scandal, right? If he was on some Conor McGregor type beat, it would not be good. You know what I'm saying? So either way, the stock would definitely plummet really, 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 really hard if something bad happened to Sailor. And then the stock could get halted GME style if the price rips too much. Again, you're taking on the counterparty risk of trusting Saylor, trusting his team, and then trusting the entire like financial system to like actually work and be fair, right? And we've already seen how they rigged the game. GameStop was going up too much. Shorts were getting liquidated. Okay, hedge funds were completely trapped. They got smoked, and Robinhood had to take away the buy button, and that was really bad. So that same thing could easily happen to MicroStrategy because they exist in a system that is controlled by the elites, right? The only system that is not controlled by the elites is the Bitcoin system. So here's the pros and cons of Bitcoin itself, just holding straight up Bitcoin in cold storage. First off, Bitcoin is 24/7, 365. All these other things I talked about do not trade on the weekend, okay? There's zero counterparty risk involved with Bitcoin. There is no one that you're relying on or trusting. It's just you. All right, that's it. This is the most secure way to store your wealth. All these other ways are much more insecure than Bitcoin itself. So this one is actually the safest. And there are no fees to hold Bitcoin, obviously, right? And you get the most peace of mind, honestly, if you're just holding Bitcoin. I would recommend, bro. Well, I mean, this is just personally what I'm doing, okay? My personal split is like 60/40. This is the new 60/40 portfolio, by the way. 60% BTC, 40% whatever the other thing you want to do, BTC adjacent, right? If you want to have a little bit of the Bitcoin miners, if you want to have a little bit of the ETF, if you want to have a little bit of MicroStrategy, right? That's the new 60/40, right? In my opinion. So that's just how I feel. That's what I like to do. As for the cons, it requires the most self-responsibility. Okay, like you are in control of your keys, meaning that you are the one who will lose your keys if something goes wrong. So it's up to you. And people don't like self-responsibility. They don't want to have to take accountability for their actions, right? They just want someone else to hold their hand so that way they can put the blame on them if things go wrong. So if you're not a accountable person, this strategy is not for you. Holding your own keys is not for you. You might have to find out something else to do. And then finally, you get the quote unquote lowest returns just holding plain old vanilla Bitcoin. And your returns, by the way, are going to look like 60% compounding year over year. So if you're not okay with that, you need a little bit more than 60%, then you might want to look elsewhere. But as of right now, that's what you're going to get. Compounding year over year, you're going to get 60%. So not too bad if I do say so myself. That's about 4 times what you're getting on the S&P 500. So not too bad. All that being said, it's up to you guys to make your decision and see what you want to do with your money. So I wish you the best of luck. I'm just here to give you a little bit of the information. Thank you so much for watching, and I will see you guys in the next video. Remember to stack sats or die trying.